After 3 straight years of record-breaking gains in the S&P 500, something shifted. The market just hit a new all-time high in early 2026, but the investors who've been crushing it aren't doing what you'd expect. They're not piling into the usual suspects. They're making very specific, calculated moves that most retail investors are completely missing. So a neighbor of mine, let's call him David, made over $127,000 in gains last year with ETFs alone. Not by chasing the S&P 500. Not by trying to pick individual tech stocks. He did it by positioning himself in 5 very specific ETFs before the crowd caught on. And when I asked him what he's buying for 2026, his answer surprised me. The exact same strategy, but the opportunities are even better now. Here's the real story behind 2026 market. If you've been watching the markets at all, you know the S&P 500 delivered an 18% gain in 2025, hitting new highs over 50 separate times. AI continued to dominate. Cybersecurity stayed hot. But here's what most investors are missing. Wall Street's biggest firms, JP Morgan, Goldman Sachs, Morgan Stanley, are all projecting the S&P 500 to hit between 7,500 and 8,300 by the end of 2026. That's another 10% to 20% from here. But that's just the index average. See, while the S&P might deliver solid returns, there are specific pockets of the market that analysts expect to massively outperform. And the investors who understand this aren't diversifying into everything. They're making concentrated bets on specific themes that are just getting started. And that's exactly what we're covering today. 5 ETFs, not your boring S&P 500 trackers, but real thematic plays that could deliver outsized returns in 2026. Some focused on income, others on explosive growth. One on a sector that Wall Street's quietly loading up on. And the last one? It's riding a commodity boom that most investors still don't understand. So let's get into it. First up, we have VIG, the Vanguard Dividend Appreciation ETF. VIG only invests in companies that have increased their dividends for at least 10 consecutive years straight. VIG automatically filters out any company that had to cut dividends during the 2008 crash, during COVID, during any market downturn. What you're left with is a portfolio of 343 companies that have proven they can grow profits through good times and bad. And here's the kicker. VIG tracks the S&P US Dividend Growers Index, and that index has actually beaten the broader Morningstar US Large Mid Cap Index on a risk-adjusted basis since 2006. Lower volatility. Better risk-adjusted returns. So let's look at the numbers. VIG currently has $120 billion in assets under management. Over the past 12 months, shares are up 12%. Right in line with the S&P 500. But here's what's interesting. The expense ratio is only 0.05%. That's the lowest cost fund we'll talk about today. So you're getting quality, you're getting stability, and you're barely paying anything for it. Now, the dividend yield sits at 1.6%. Which, yeah, isn't the highest yield you'll find. But the dividend growth rate? It's been growing at 10% annually over the past 5 years. And the fund has increased its dividend for 12 consecutive years. So this isn't about chasing yield, it's about owning companies that are compounding their cash flows year after year. When it comes to sector exposure, VIG leans into technology. About 27% is in tech, giving you exposure to the AI boom without the concentrated risk. Then you've got financials at 22%, healthcare at 16%, industrials at 10%, and consumer defensive rounding out the top 5. This is broad diversification without diluting the core quality focus. And the top holdings? These are household names. Broadcom, Microsoft, Apple, JP Morgan, Eli Lilly, Visa, ExxonMobil, Johnson & Johnson, Walmart, MasterCard. The top 10 holdings make up 37% of the fund. But here's the real edge with VIG. This fund tends to outperform when markets drop. In 2022, when the S&P 500 fell, VIG beat the category index by 10 percentage points. The downside? In really strong bull markets, VIG can underperform a bit. In 2024, it returned 19% but underperformed its category index by 7 percentage points. So if you're looking for explosive growth, this isn't the play. But if you want a core holding that delivers stable, compounding returns with lower volatility, VIG is one of the best options out there. It's the kind of ETF you buy, hold for a decade, and let dividend growth do the heavy lifting. Let's move to something way more aggressive. The Global X Cybersecurity ETF, ticker BUG. And this one's interesting because it's actually down 9% over the past 12 months. Most investors see that performance and think, why would I buy something that's losing money? See, here's what's happening in cybersecurity right now. Global cybersecurity spending is projected to grow from $178 billion in 2024 to over $450 billion by 2030. That's a 150% increase in just 6 years. And the reason is simple. AI is making cyber attacks way more sophisticated. Companies can't afford to cut back on security spending. It's mission critical. But here's the problem with Bug's recent performance. Cybersecurity stocks aren't struggling because the thesis is wrong. They're struggling because investors now demand perfection from high-growth software companies. Even when these companies report strong results, if they miss by even a tiny bit, the stocks get hammered. Take Zscaler, one of Bug's top holdings. The company reported solid operational performance, but investors punished the stock anyway. Analysts are calling this the perfection regime, where only flawless execution is rewarded. And that's created a massive opportunity for investors who can look past short-term volatility. So let's look at Bug's setup. The fund has $920 million in assets under management with a 0.51% expense ratio. It's down 9% over the past year, which has created an attractive entry point. But here's the key. JP Morgan just upgraded the sector outlook for 2026, citing that enterprise IT budget announcements in January and February earnings calls are signaling strong sector momentum ahead. Bug is almost 100% invested in technology, specifically cybersecurity names. The top holdings include Check Point, Fortinet, CyberArk, Palo Alto Networks, Akamai, CrowdStrike, Okta, Verona Systems, Gen Digital, and Rubrik. In total, the fund has 31 holdings, and the top 10 account for 55% of the portfolio. What makes Bug compelling is the non-optional nature of cybersecurity. They cannot afford to cut cybersecurity. One breach can cost millions, or in some cases, billions, in damages, legal fees, and reputation hits. And here's the thing about Bug's recent dip. It's created a buying opportunity in a sector that's poised for explosive growth. Analysts project that by 2026, AI data center demand alone will drive a huge surge in cybersecurity needs. Every new AI system, every data center expansion, every grid upgrade needs layers of protection. So is Bug risky? Absolutely. This is a growth ETF in a volatile sector. But you're getting in at a discount before the next leg up. But if you want pure AI exposure with less volatility, that brings us to ETF number 3. ARTY, the iShares Future AI and Tech ETF. And this one's a bit different from your typical AI fund. Most AI ETFs are just overweight Nvidia and a handful of mega-cap tech names. ARTY is blending small caps, mid caps, and large caps, giving you exposure to the entire AI value chain. So here's the setup. ARTY currently has $2.2 billion in assets under management. Over the past 12 months, shares are up 37%. That's crushing the S&P 500's 14% return. The expense ratio is 0.47%, which is reasonable for a thematic ETF that's actively selecting across market caps. But what makes ARTY special is the index it tracks. The Morningstar Global Artificial Intelligence Select Index. This index doesn't just look at companies that make AI chips. It's looking at the full AI ecosystem, generative AI, AI data and infrastructure, AI software, and AI services. And it excludes China and India entirely, avoiding regulatory risks in those markets. So when you look at ARTY's sector exposure, it's heavily skewed toward technology at 85%, but then you've got industrials at 4.9%, communication services at 4.6%, and utilities at 2.67%. That industrial and utilities exposure? That's capturing the infrastructure build-out that AI requires. Data centers, power systems, cooling infrastructure. The top holdings tell the story. Micron Technology at 5.3%, Nvidia at 4.8%, Taiwan Semiconductor at 4.8%, Naver at 4.6%, AMD at 4.5%, Marvell, Oracle, Broadcom, SK Hynix, and CoreWeave. In total, the ETF has 67 holdings, and the top 10 account for 42.6%. So you're getting diversification, but you're still concentrated enough to capture outsized gains. Now here's what's interesting. BlackRock, the issuer of ARTY, believes AI infrastructure spending will hit $5 trillion to $8 trillion through 2030. That's not speculative. That's based on real capital expenditure commitments from Microsoft, Amazon, Google, Meta, and others. These companies spent over $500 billion on data centers in 2025 alone. And ARTY captures that entire build-out. You're not just betting on chip makers. You're betting on the companies that build the servers, the memory systems, the networking equipment, the software platforms, and the cloud infrastructure that makes AI possible. Now, we've covered income with VIG, growth with BUG, and aggressive growth with ARTY. But the next two ETFs? These are the ones that could really surprise people in 2026. One is a cyclical play that Wall Street's loading up on. And the other is riding a commodity supercycle that most investors still don't understand. Let's keep going. So the fourth ETF is XLF, the Financial Select Sector SPDR ETF. XLF currently has $55 billion in assets under management with a dirt cheap 0.08% expense ratio. Over the past 12 months, shares are up 11.5%, which might not sound crazy, but it's outperforming a lot of the market right now. And more importantly, fund flows tell a different story. In January alone, $1.2 billion has flowed into XLF. So why are investors piling into financials now? There are four major tailwinds converging at once. First, deregulation. The Trump administration is rolling back a lot of the financial regulations that were put in place after 2008. Less regulation means banks can be more aggressive with lending, with M&A activity, with capital deployment. That's a huge positive for earnings. Second, interest rates are stabilizing. After the Fed's aggressive rate hikes in 2022 and 2023, rates are now holding steady. And while falling rates help consumers, stable rates help banks. They can lock in profitable lending spreads without worrying about sudden yield curve inversions. Third, earnings growth. The big four banks, JP Morgan, Wells Fargo, Citigroup, Bank of America, are all signaling strong earnings growth heading into 2026. Analysts at KBW and RBC are calling for continued double-digit earnings growth in the sector. And fourth, M&A activity. Analysts are expecting a wave of mergers and acquisitions in 2026. And guess who benefits when M&A activity surges? The investment banks. Goldman Sachs, Morgan Stanley. The entire capital markets ecosystem wins when deal-making picks up. So let's look at XLF's holdings. It's 100% financials, obviously. The top holdings include Berkshire Hathaway at 11.7%, JP Morgan at 11.17%, Visa at 7.5%, MasterCard at 5.9%, and Bank of America at 4.7%. The fund holds 80 companies in total, and the top 10 account for 56%. And here's the thing about XLF. It also pays a dividend. The yield is 1.3%, and the dividend has grown at about 4% annually over the past 5 years. So you're not just getting capital appreciation, you're getting paid while you wait. And now for the final ETF. The Global X Copper Miners ETF, ticker COPX. And I know what you're thinking. Copper? Why would I invest in copper? But here's the thing. Copper might be the single most underrated commodity play for 2026. Why? You ask me? COPX has $4.6 billion in assets under management with a 0.65% expense ratio. Over the past 12 months, shares are up 97%. Not 9.7%. 97%. That's almost a double. And copper prices just hit a record high above $13,000 per metric ton on the London Metal Exchange. But here's why copper is exploding right now. There are three massive demand drivers all hitting at the same time. First, AI data centers. Every single AI data center requires enormous amounts of copper. You need copper for power transmission lines, for transformers, for cooling infrastructure. When Microsoft builds a new AI training cluster, they're not just buying GPUs, they're buying thousands of tons of copper to wire the entire facility. JP Morgan projects that AI infrastructure alone will drive copper demand to an average of $12,075 per metric ton through 2026. That's not speculation, that's based on actual COPX commitments from big tech. Second, electric vehicles. Every EV uses about 183 pounds of copper, 4 times more than a traditional gas-powered car. As EV adoption accelerates globally, copper demand skyrockets. And it's not just the cars themselves. You need copper for the charging infrastructure, for the grid upgrades, for the entire electrification ecosystem. And third, the energy transition. As the world shifts toward renewable energy, copper becomes mission-critical. Solar panels, wind turbines, battery storage systems, all of them require massive amounts of copper. S&P Global recently published a report stating that copper demand is expected to increase by 50% by 2040. So supply and demand are colliding in a way we haven't seen in decades. Now let's look at COPX's holdings. The fund tracks the Sol Active Global Copper Miners Total Return Index, giving you exposure to 41 copper mining companies globally. The top holdings include Freeport-McMoRan, Southern Copper, Antofagasta, First Quantum Minerals, and Teck Resources. The top 10 holdings account for about 47% of the fund. And here's the bonus. COPX also pays a dividend. The current yield is about 2.67%, and the dividend growth rate over the past 5 years has been strong. The dividend is paid semi-annually, so you get income while you wait for copper prices to climb higher. Alright, so we just looked at 5 very different ETFs. VIG for stable dividend growth. BUG for cybersecurity exposure. ARTY for aggressive AI upside. XLF for financials in a deregulation cycle. And COPX for a copper supercycle driven by AI and electrification. And the key here is diversification across themes. So take a look at your portfolio. In 2026, the investors who win aren't the ones who just buy and hold the S&P 500. They're the ones who position themselves in the right themes before the crowd catches on. And if you found value in this breakdown, hit that like button below. Subscribe to the channel. I'll see you in the next one.